Good morning. It is episode number 123 of the 39.6 show. Today's episode for Monday, November 9, 2020. This is the 39.6 Facebook and YouTube Live Finance Show. It's a show that teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, and even the car you drive. Today, we're going to dig further into multifamily financials. We're going to go over a T12, explain above and below the line expenses, and the expense ratio in multifamily properties. All right. Now, when you buy a property, this is very similar to what my previous spreadsheet looked like from episode 122 and prior. Okay, I made this a bigger property, and instead of utilizing the expenses that I had as standalone for a whole year, they are now expenses for just 1 month. Okay, so let's pretend we bought a property for $20 million a year ago in November 2019 for 80% loan to cost, 20% down payment. So that'd be $4 million down. And that is going to be all the cash that is deployed into the asset at the beginning for the purposes of this demonstration. Okay. Now, when you buy the property from the previous seller, you have their rental income numbers, and I'm just going to use these numbers and assume these are the numbers that they had prior to you buying it, and they are going to be the same in the month you buy it. So $120,000 of rental income, $10,000 of other income for a total of $130,000 of total revenue. Then our expenses are listed out here: payroll, G&A, property management, marketing, repairs, contract services, turnover, utilities, insurance, and real estate tax. This is the same as in the previous episode. And all of those expenses discussed are all tax deductible, and they are all above the line. Okay, so those are all operating expenses to the asset itself, and they are not related to the expenses of the investor to have the asset, because those are going to be different and discretionary from person to person. But those that are operating expenses here are intrinsic to the asset. So those above the line expenses total $65,000. Now, this black line is the line. Okay, so that line separates the above the line expenses and below the line expenses. We're going to get to the below the line expenses in a moment, but the net operating income here is simply the total revenue minus the total above the line expenses. So in this situation, it started at $130,000 minus $65,000 for a total of $65,000. Now, this definition of expense ratio is simply the proportion of the total revenue that is allocated to the net operating, to the total above the line expenses. So you would take this top 65,000, divide it by 130,000 for a 50% expense ratio. Now that's like a rule of thumb in a lot of rental properties, especially single family. 50% of your income will go to expenses. It's just kind of a broad rule of thumb, but really depends on a lot of factors. Okay, but in this situation, I just set up the math so that it's exactly 50%. Then we have all of our below the line expenses. So debt service, our 3% interest only mortgage, is $40,000 per month as a payment. Okay, remember our term, the debt service coverage ratio. That's the net operating income divided by the debt service. Okay, now that's usually done on an annualized basis, but for the purposes of this maths, I show it here per month. And then we have our asset management fee, which is often 1 to 1.5%. And so that's in addition to the property management fee. So if you own an asset directly, you're not necessarily going to pay for an asset manager. You might, but if you are investing in a syndication, there's compensation to the person who's managing the asset at the asset level, not within the property, but managing the deal. Okay, so that's an asset management fee. And then you have your capital expenditures. In this example, I have $10,000 per month going into CapEx. So these are not expenses for repairs, but these are dollars that are being deployed to potentially improve the asset. These are discretionary expenses. Now, in this example, your net operating income is $65,000 and the debt service is only $40,000, so that leaves $25,000 left. You pay the asset manager $2,000, there's still $23,000 left. And so then you can still put $10,000 into the asset and invest it. So for example, every month you could turn over a unit and renovate it from basically a 10-year-old trim level to new. Okay, you could deploy 10,000, get new appliances, new counters, blah, 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 refinish the flooring, paint, light fixtures, whatever. You throw in 10,000, you could do that 1 unit per month at $10,000, maybe even 2, depending on what you're doing. Okay, maybe multiple. But a lot of times people raise capital expenditure cash on the front end and just deploy them all at once. Here's an example where we're just going to do it from the cash flow per month. Okay, so you're reinvesting $10,000 into the asset. So the total below the line expenses is $52,000, and the net operating income is $65,000. So there's still actually an additional $13,000 of cash that's built up per month. Now, in this example, I use the exact same expenses all the way across the board from November all the way through October of 2020. The same thing for rental income. Now, here we have 12 columns from every month from November 19 all the way until October 2020. So this is what we call the trailing 12, the last 12 months. Okay, during the course of the year, rental incomes will ebb and flow, expenses will go up and down. But when you have a full 12-month summary, it gives you a good picture of the asset, because some things are more once in a year expenses. And when you're using accrual accounting, usually you still kind of spread them out over the 12 months, but there's still going to be some adjustments. Now, one of the weaknesses of looking back 12 months is that as leases come up, you could be increasing the rents, and your rents could continue to go up every month, and your market rent could be a lot higher this past month in comparison to what it was a year ago. And so the value of the asset, some people might say, is different from looking at it over a course of 12 months. I'm going to cover that in probably the next episode. But in this example, if we keep every single thing the same, we end up with 1.56 million of total revenue, 780,000 of expenses, expense ratio of 50% all the way across the board. Okay. And the value of the asset is going to be exactly the same because we've changed nothing. So if we sell it at the same cap rate that we bought it for, which is 3.9%, then we would be able to sell it for $20 million, which is the price we got it for. Okay. Now, we're going to go back and make some adjustments. Let's pretend we're able to increase the total rental income per month by $1,000 per month. So I'm going to go to December of 2019 and add $1,000. And now it's $121,000 instead of $120,000. I'm going to drag that forward and it's going to go all the way across. Okay, and you could increase the rental revenue by various different things. Every time a lease comes up, you could have like 10 new leases come up per month and increase them by $100 per lease. Also, the vacancy might be a little bit higher than you'd like it. It could be at 90% and you're trying to get to 95%. So between a combination of those two things, increasing occupancy and increasing rent per unit and rent per square foot, you can drive that up. So we're going to take an example of going from 120,000 all the way up to 131,000 over a 12-month period. And then other income, let's just say we're going to add valet trash one at a time, and we're going to increase the income to that. And I'm going to say plus $100 per month, and we're going to bring that all the way across. And then that gets up to 126,000 instead of 120,000. So we're pushing up the revenue side substantially. And then let's pretend we're able to fight our property tax. So instead of it being $300,000 or $20,000 per month, you argue it in the summer and they agree to decrease it to, let's say, $280,000. So let's just say the last 4 months we decrease our 20 to 20,000. Okay, so 20,000 per month for those last 4 months, and the total is now 280. So we have both increased revenue and decreased expenses. And look at our expense ratio. It starts at 50% and it goes down to 42%. So that's fantastic. And an average of 47% over the whole year. Well, what happens when you do this? We've now substantially improved the net operating income up to $871,000. Okay, it used to be 65,000 times 12, which is 780,000. So we've increased it by $91,000. Now, if we again look at our cap rates, our cap rate we bought it was 3.9%. And let's just pretend it's the same 3.9%, and we want to sell it after 1 year and a day so that you're not paying short-term capital gains. Well, that increase of $91,000 is basically multiplied by 25, because you take that 91,000 and divide it by 3.9%. It's basically the same thing as multiplying it by 25. And that gives you all of this profit here of $2.3 million. Now, in reality, you'd have to pay commissions and whatnot, but you've created $2.3 million of value over the course of just 1 year by doing a few different things: decreasing expenses, increasing rental income and other income, and improving your NOI. So that is how you look at a trailing 12, last 12 months. When you're buying a property, you look at this as one of the main things you need to look at to assess the financial, the value of the asset. And also you can assess how you're doing when you're managing a property at pushing these rents up and decreasing your expenses. All right, that is it for today. Again, none of this is legal, professional, financial, or otherwise advice, simply for my entertainment, hopefully yours. We're going to dig into more in our next episode.